Talking Real Money.
Hello, everyone. Welcome to Talking Real Money, the podcast about money. I'm Don McDonald. Over there is Tom Cock. We're glad you're out there wherever you are in podcast land, sitting in your car, running this through CarPlay or Android Play, or sitting at home with your headphones on, or piping it all through the house on your smart speakers. We're just glad you're
dog.
doing it.
We get that one a lot.
Dog.
Yeah, we get that one a lot.
We're walking the dog. I got a big backyard, so I don't walk my dog very often. Although if we get out in the Airstream, there'll be more dog walking. Be good for me. Anyway, welcome to the show where we talk about your dough and other people's dough too, and how things impact you and the way you ought to think about money and do with your money. And today, we're going to talk a little bit about management of funds. And we're going to start with one of the more famous managers of essentially a mutual fund. We're talking about the people at Berkshire Hathaway. And by the way, the second in command at Berkshire Hathaway, Charles Munger, just recently passed away. And it's funny.
How's that funny? Come on.
No, this is funny.
Oh, okay.
I said, "Oh, did you hear Charlie Munger died?" to my wife, and she goes, "Who's Charlie Munger?"
What? Because he's number 2. She doesn't know.
I said,
"I'm surprised she doesn't." Because she's very well informed.
You got to wait for the punchline.
Ah, okay.
There is a punchline here.
Please.
She goes, "Who's Charlie Munger?" I said, "Warren Buffett's partner." I didn't know Warren Buffett was gay.
Oh, God's sakes! Come on. I hope she.
No, totally serious. Totally serious. I said, no, honey, not that kind of partner, business partner. So, Tom.
And do I need to specify that when I tell people that you're my partner?
Yes, that's what I was going to say.
Because people say, I go, Don's my partner. And they go, my business partner.
I know,
okay?
I know.
And it's okay either way, but I hate to
listen to you try to, it's like, it's okay either way. I'm not judging.
I'm not judging at all. I'm not, just weird that you have to clear
Tom
that out.
is my longtime business
partner. And I know
partner.
how Munger felt because I'm the number 2 guy on the show. I get that. You're the number 1 guy. So and I'm okay with that.
I think I gave you more time last segment. I looked.
I looked up and started checking.
I looked.
But Munger had a great reputation of his own. As somebody who is kind of quotable, pithy, he wasn't out there. I think they made a lot of good decisions, and they both thought a lot the same. I think
They thought a lot.
They thought a lot, comma.
They thought a lot.
A lot of thinking going on there. Because Berkshire Hathaway's had a great run,
my
right?
Partner, ladies and gentlemen.
That's business partner. Because Berkshire Hathaway's had a great run, right? I mean, it's.
Right.
For decades.
They have. They've made people a lot of money. But before we get too excited about Berkshire Hathaway, this is the reality of a Berkshire Hathaway, is that it had periods in which it was incredible, but most of those periods were early in its history. As it got bigger and more people were involved and it had more money, it did what so many systems and products and methods of managing money do. It became average. It reverted to the mean because its long-term returns have been pretty much in line with the market.
Which part of the market?
The S&P 500.
Oh, okay. Because it is a value.
We call the market
value fund. I mean, it's trying to buy
undervalued assets.
Companies.
Yes,
right. That's the whole idea. And them up.
But recently, value has not been extraordinary.
It has not very at all. So there's a lot of lessons, I think, not necessarily from Charlie Munger's life, which I think is a life well lived, no question. But about owning a fund where people are making those judgments about individual stocks, right? Active management, stock pickers, market timing, all those things, versus just owning the market. Because when Mr. Munger passed away, he was the 3rd longtime Berkshire Hathaway director who died while being a director. All of them were in their 90s. Now, Do you think the world looks different to somebody in their 90s than compared to us young guys in our 60s or somebody in their 30s?
Well, I know it looks different to some guy in his 60s than it did to the same guy in his 20s.
There you go. Your perspective on things changes, right? So that's one thing to consider. And a lot of them were men. It was like 75% of the directors are men. The median age, 67, which is, it's not young, but it's not old. I mean, it's kind of old.
It's getting up there.
Yeah, it's getting up there. Those people have a way of looking at the world. They've had a fair amount of life experience. But there's pressure now. There's pressure on Berkshire's board from other members, including Warren Buffett's daughter, Susan Buffett, to get some, people of color in there. They've got one, I guess, more people of color, a little younger, trying to change things up. But here's how I look at all this. That's the worry of owning a fund like this. Exactly the worry, because you buy Berkshire Hathaway for exactly what Don just said. Good return, focus on value stocks, long-term orientation, right? Mm-hmm. That's why people have owned it. And you've done well by that.
Oh, you've done very well, by the way. I mean, the 15-year average annual return for Berkshire Hathaway is 13%, and that reflects that value, because the S&P 500 over that same 15-year period came in slightly below that. So you made good money, but what are your future expectations?
Yeah, you cannot buy that performance, and you cannot buy that same style of management, because eventually Warren will go, because I think he's in his late 90s as well, right? I mean, are very close to it. These other board members move off. They bring in new board members. They, at some rate, have to bring in new people to manage the money. So now you bought a fund you think looks a certain way, but it's not going to look that way in the future. That's the danger of owning an actively managed fund of any type, because you can't buy the performance, and the future will have to look different. And even if it's just keeping the same people and letting them still be having an impact on things in their late 90s, as I said, the world looks a lot different to people who are 98 than it does to somebody who is 38, for example. So that's a worry. The other one, frankly, is, and I don't know what, you can look this up, I'm sure, what is the expense ratio for, although it's a stock, right? So you don't really have an expense ratio per se, correct?
Well, they've got some sort of expenses, but
I'm putting you on the spot. I didn't tell you.
Yeah, no, I truly.
But in a general sense,
I got to imagine it costs more to run, but because it trades as a stock,
it's different.
I don't think you can get its expense ratio.
Yeah,
but the expense ratio for the S&P 500. Which, by the way, I got the exact number. I thought it was a little lower, but it isn't. It was a little higher over 15 years. They both earned about 13.5% over 15 years. Yeah. But the expense ratio, the internal cost of running an S&P 500 fund, because you're not paying a bunch of people.
Right. It's just a computer.
0.04%.
There you go. I mean, so, and in a general sense, if you buy mutual funds, exchange traded funds that are more passively rules-based, they're going to be cheaper than an operation. They have to be, like a Berkshire Hathaway or somebody else.
Don't ever say have to be.
I meant don't say guaranteed. Oh, pardon me.
Should be.
Should be in a general sense,
because we've seen index products that charge ridiculous expense ratios.
Yeah, who's the company? I'm forgetting about.
Oh, yeah, the one with all the weird.
They use leverage, and you can go up 300%. But the point of the matter is. And the other part is very important, I think, especially when it comes to this comparison between index style funds and active style funds. We can't find, and Berkshire Hathaway, bless them, they've done a good job long term, but in a general sense, it's hard to find people that have performance that persists decade after decade that's better than just owning the market. That's the tough part. And I think that's going to be the story here with Berkshire Hathaway, because it will change. It has to change. It'll be different people running it, different people sort of managing the big picture, and it'll look different, right? They might pick a ride sharing service instead of a See's Candy. I don't know. I mean, who knows what they might do?
Absolutely. And I think what you're talking about, is it Direction? I think that may be the one.
No, Yeah, I know who you're, but I could, and I could.
Ridex.
Thank you.
Yeah,
Ridex.
The Ridex S&P 500. Now that is identical to the Vanguard 500 index. That was 0.04% for the fund.
Yeah. How much?
And so you can't say, this is why I have to correct you.
Thank you. I'm good with this.
It's better than compliance correcting you.
Which they will.
Yeah. All right. You ready?
Yeah. How much for the Ridex 500?
Again,
I can see it pains you. Yeah.
This is like the podcast on Monday where I said the expense ratio for the Nuveen bond fund. This should be a dirt cheap fund.
Right. Costs nothing to operate,
they don't do anything.
Nope.
Except the C shares have an expense ratio of 2.36%.
And how much is in that fund, please?
2.36%.
That truly is outrageous. We should get him on the show. Is it Michael still that runs the place? Because I met him once. Anyway, it was a long time ago.
The funny thing is they have a 700% turnover. How can you have a 700% turnover when it's an index fund?
And how much money is in that fund?
I don't know.
I'm just dying to know. Anyway,
I'm trying to
but in a general, I'm going to keep saying it too. In a general sense,
$159 million.
I mean, why people, please, if you're in that fund, sell now and buy the Vanguard S&P for what?
Why is anybody in the fund?
Inertia. They bought it a long time ago, and they just, I'm in the S&P 500.
Bear in mind, it's a C share.
Yeah. Okay.
So it was sold to them.
Good point. So that's
the first line in Morningstar's research is fees are a weakness here.
They should have included massive weakness. So
that is an understatement, dudes.
Anyway, so my bottom line still remains. This is a reason not to own, and not that reason. This reason I mentioned before is a reason not to own an actively managed fund. I think because it's going to look different than it has in the past. It has to. That's my problem.
There you go. Words of wisdom from my partner.
Oh, please. I don't care which kind of partner it is. I literally don't care. It doesn't matter to me.
He is a broad-minded old guy.
Doesn't matter.
Hello, everyone. It's question time here at Talking Real Money. And, you can send your questions into us at talkingrealmoney.com on the contact form. You can either type them up like the one Tom's going to do or the two, or you can speak them with the little microphone button, and then I'll do those on Fridays.
Love Fridays. Still love Fridays. Show the best. Great
Friday, Q&A day. Yes. What do you got next?
All right. I don't understand this one. I'm hoping you do because you are the same.
See, now, just to let you know, I have not seen this question.
Not seen any of this in advance.
This is almost like live radio, but it's not.
It is close. This comes from Jared in Corpus Christi, Texas. Jared. The subject, Vanguard VIF funds. VIF funds. In my company's non-qualified deferred compensation, NQDC plan, the lowest cost offerings are Vanguard VIF index funds. What are variable insurance funds? They have higher expense ratios. Am I getting ripped off by not having a standard index fund? Well, no, not if you compare it to Ridex. You're not. The fund I've been selecting for 100% of my balance is the variable insurance fund total stock market index portfolio. I've never heard of this.
Yeah, it's insurance.
So what is insured?
I think it's an annuity. It is run there. Let's see. I'm just trying to find their funds. This is really crazy.
So
but
Vanguard,
what's funny about
Vanguard?
This? Vanguard is starting to become the pandering to whatever people want fund group.
That's not new. They've done that for almost a decade now.
Really,
they waited for Bogle to die.
They waited for Bogle to die because John would have never done this.
A lot of things.
So I am doing this right here live on recorded. Anyway,
live to tape. That's good for you.
Wow. What in the world is it? It's got to be a variable annuity product.
In their non-qualified deferred comp plan. So I guess I can see that. Yeah. Okay.
Yeah. Gotta be. It's gotta be. It's a variable annuity.
I wouldn't put any money into that plan with that. Period. I'd just exit
But
out.
it may be the only thing available.
I'd use the traditional. If they have
No. But over, you see, the non-qualified plan.
Oh,
that
gosh.
may very well be the only choice,
and that's how they sell it too.
And at least their fees are low. They are very low. The balanced portfolio is 0.25%.
That includes the insurance cost?
I don't know.
Or from what you can see. Okay.
I'm looking at the fund.
That sounds low, but okay.
I am looking at the fund. I'm looking here, for example, let's look at the Vanguard Diversified Value portfolio. We like value.
Sure.
Expense ratio 0.29. But it is active. That's active.
That's cheap.
I'm gonna have to learn more about this.
We'll see if we can get back to that later.
Sorry.
I got an easier one for you, okay? And we're going to disagree on this one.
Download the prospectus. I'm downloading the prospectus.
Give you something to read tonight as you're trying to get to sleep.
Oh, I love reading prospectuses.
I know you do.
All right, go ahead.
Usually the ADV guy. All right, this from Dave in Aberdeen, North Carolina. We have an Aberdeen, Washington, too.
There's an Aberdeen in North Dakota, too.
How about that? Yeah, a lot of Aberdeens going on.
South,
hi, Tom and Don. Tom and Don, I'm 41. I guess that's years old. Scored an 82 on your risk quiz.
Ooh.
Currently have all of my investments in low-cost mutual funds and ETFs. Hey, way to go, Dave.
Well, then why are you calling us?
Well, I'm getting to that. I don't mind the volatility of the market. I've never understood why I would want any of my investments in bonds if they have historically a lower return. When I'm a few years from retirement, trading potential returns for stability makes sense. But is there something I'm missing at this point in my life with my risk tolerance?
No.
We're going to have a difference of opinion here.
No.
I'm going to say yes.
Nope.
I'm going to say put 10% in bonds. Here's why.
I'm going to say 0.
They're a different type of security, and there will be times when they outperform stocks.
I disagree.
Oh, well, no, I'm right about that.
There will be brief times when
one out of 4 years. One out of 4 years. If you believe
but I
history.
think overall, given his time frame
I'd put
and
10%.
his risk tolerance, I'm just saying overall, his returns should have, based on the past, if the past is in any way indicative of the future, and it's not a guarantee, then the stock, a 100% equity portfolio should make more money. It has made more money over time. So when you get to your 40s or your 50s, and
he's already in his 40s, 41.
Well, late 40s, early 50s. Then you might want to consider
like 8 years from now or something.
41 is the new 31.
Got it. You got another 50
do you feel
years.
66?
Yeah, today actually.
Okay,
this week.
But
yesterday,
speaking,
day before. Mm-hmm.
See, we're losing him quickly. A lot faster than I
straight
thought.
Down. I would have 10% just because it's a different type of security and it's more diversification. That's why. So there you go.
I'm a knower. He's got an 82 on the risk quiz.
I know. Congratulations for that, because very few people get beyond about an 85.
I mean, even the first time I
think
took
I had
it,
an 86 or something.
Yeah. I think I was like an 82, 81.
So it's hard to get up there.
And I get this. So he gets it. Yeah. Apparently that means he gets the market. And that's the key. The key to successfully investing in a portfolio that's heavy in equities, if not 100%, is getting the market and totally understanding that downturns, particularly if you're still saving, a downturn in any of the stock markets that you invest in is a good thing, because you're buying more stuff on sale. And that's hard to
getting the market. It's like my first marriage. Embrace the volatility. That's what I would say.
Different kind of volatility. Don't know how you would have put a bond fund in that to reduce that.
Boy, I sure wish I had a couple then.
Wait a minute. Easier. Now I can think of a metaphoric.
Yeah, please. Yeah. Go right ahead.
Let's not discuss it on the show.
Okay, fair enough. Fair enough. Anyway, Dave, there's your reply. You get two different. So you get to split the difference. Put 5%.
5%. That's exactly right. I'm thinking, let's split the baby. Dave, do 5% in bonds.
The fact is, you're thinking about this stuff. You're making good decisions at age 41. You're probably going to be okay, because a lot of people still don't till they get to about 60. So well done. Yeah.
Yeah. Oh, yeah. You're just projecting.
That hurts. Again.
I just started making good decisions lately, he says.
You're killing me more. I thought you were trying to save me, but okay, fine.
I don't believe in killing you softly.
Exactly. It's coming.
Where did you go?
Just recycling things.
In the middle of the show. You couldn't wait till it was over.
No, that's how I work.
You stayed by your microphone.
Okay, yes, sir.
All good broadcasters and podcasters do not leave the microphone. Oh, and speaking of soundproof booths, you said I was in a soundproof booth?
I don't hear anything.
In 2 weeks, I'm actually getting a soundproof booth.
Like a little, like a phone booth kind of thing? One of those?
Yeah, kind of. Look it up online. It's called Studio Bricks.
And where are you going to put it?
Right behind me.
So what? Oh, you mean so you're going to go in Don McDonald live from NBC?
Like exactly. That kind of thing? It's all padded. It's padded everywhere, which is really good.
And can it be locked from the outside?
And no, but it can be locked from the inside. And and so that means I could just hide in there.
And you can't tell if anybody's in there?
I can double my level of hiding.
Ooh. So you get the studio plus the inside. So you're getting this because
of dogs barking.
Oh, I see. Okay, and every once in a while you do hear a dog on the show. Yeah, I get
dogs barking, leaf blowers.
Yeah, the worst.
Now our hospital is starting to fly people in and out on the Flight for Life, which I can literally see out the window.
Wow!
And the Flight for Life helicopter is really loud.
Okay.
Garbage trucks.
Whatever. Angry neighbors, etc. So
I've tried to soundproof my room.
Hurricanes.
But without spending a lot of money, I can't.
Okay.
So I'm getting a soundproof booth. You'll be hearing the show from inside a soundproof booth.
There's Don McDonald inside
a soundproof booth.
I'm signing up now.
Anything else you want to add before we let these poor people go?
No, I hope they're rich people. Why do you say poor people?
I'm sorry. I meant it as in their suffering.
Oh, as in long suffering. Got
suffering.
it. Okay, fair enough.
All right. If you want any help, go to talkingrealmoney.com, click on Meet an Advisor, or just browse around the site. There's just a ton of good stuff. We must have hundreds of articles on academic research, and indexed annuities, and all kinds of cool stuff. And all of our 1,306, 1,307. No, by this time, we're probably at 1,310 podcasts.
Crazy.
Yeah, lots and lots.
Are we going? Do we have like a number we're trying to do total?
No.
Okay. We'll just keep doing them.
Until we drop.
Whatever number it is.
Yeah. And then
you can't drop because you'll be in a booth. You'll be hitting off the wall and standing up.
I'm going to be buried in that booth.
It's going to pick it
so
up.
I figure
right
it serves double purpose. I'm going to die in that booth. You just lock the door. Drop me in a hole.
Okay. You can't dig a hole in Florida because it'll be full of water, right?
They must have someplace because people die here.
Okay. Boy, do they. Anyway.
Yeah. All right. They're old. I know. I got to go.
Yeah.
All right. That's that guy, Tom, drifting over to the recycler again. And I'm that guy, Don. And almost every day, about 5 days a week, maybe 6, we just hang out together, partner to partner, and talk money. Real money. Talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. still listening?